digital age is truly upon us. And in recent years, there's no development more talked about than Bitcoin. Forget about dollars, pounds, and euros. Now, we're in the era of digital gold.
Market analysis is a cornerstone of successful investment and trading strategies. It involves examining and interpreting market data to forecast price movements, evaluate investment opportunities, and guide financial decisions. Various market analysis methods give traders and investors insights into market trends, economic cycles, and potential investment risks and rewards. Section 1. Fundamental analysis. One popular method of market analysis is fundamental analysis. This strategy focuses on comprehending the inherent worth of a financial asset. It involves analyzing economic indicators, industry conditions, and company financials. For commodities, fundamental analysis involves studying supply-demand curves, weather patterns affecting production, or geopolitical events that disrupt supply chains. For stocks, it often involves looking at revenue, profits, future growth, and overall company health. The goal is determining whether an asset is overpriced or underpriced about its current market price, making it a crucial tool for long-term investment decisions. Section 2. Technical analysis. Technical analysis, in contrast, relies on statistical patterns, including volume and price movement, gleaned from trading activity. Unlike fundamental analysis, it does not concern itself with the asset's intrinsic value but with patterns and trends that suggest future motions. Technical analysts employ a range of graphs and signals, such as moving averages and relative strength indices, to predict market direction. This method is prevalent among traders who seek to profit from transient pricing changes depending on market sentiment rather than long-term value assessments. Section 3. Sentiment analysis. Another insightful approach is sentiment analysis, quantifying investors' psychological and emotional attitudes. It involves analyzing news headlines, social media feeds, and market commentary to gauge the market's mood. Tools like natural language processing help effectively scale this analysis to parse through vast amounts of text data. The underlying assumption is that positive or negative sentiment can drive market movements as significantly as fundamental economic factors. Section 4. Behavioral economics in market analysis. Behavioral economics introduces another layer to market analysis by considering how various psychological factors, such as biases or irrational behaviors, affect investment decisions. This field of study examines patterns in human behavior that consistently deviate from rationality and how these patterns influence the financial markets. For example, the tendency of investors to hold losing investments too long or sell winning investments too quickly can be analyzed to predict market behavior under certain conditions. Section 5. Macroeconomic analysis. Macroeconomic analysis is also a fundamental part of market analysis, particularly for understanding broader market trends. This method examines overall economic conditions, including GDP growth, unemployment, inflation, and monetary policies. By understanding the macroeconomic environment, investors and analysts can predict which types of investments will perform well during different economic cycles. Section 6. Comparative analysis. Additionally, comparative analysis is helpful, especially when dealing with equities. This method involves comparing companies' financial ratios and metrics within the same industry. By assessing these comparative metrics, analysts can identify which companies are performing better or worse than their peers and make investment decisions based on these insights. Section 7. Quantitative analysis. Lastly, quantitative analysis uses complex mathematical models to predict market movements. This approach mainly depends on historical data and numerical metrics to forecast future price behavior. Quantitative analysts use statistical techniques to develop trading algorithms and models, often incorporating machine learning and artificial intelligence elements to enhance predictive accuracy. Section 8. Combining methods for a holistic approach. Practical market analysis typically involves a combination of these methods. While each has its strengths and weaknesses, integrating different approaches can provide a more holistic view of the market. This multifaceted analysis helps in making more informed, balanced investment decisions. As markets continue to evolve, so do the methods for analyzing them, with new technologies and data sources continually expanding the analyst's toolkit. For anyone involved in finance, developing a firm understanding of these methods is crucial for navigating the complexities of today's economic and financial landscapes. Section 9. Technical Analysis Tools and Indicators. One essential tool for traders and investors is technical analysis. It offers a way to interpret market sentiment and use historical data to predict future price changes. This method utilizes various tools and indicators to evaluate market conditions and identify trading opportunities. Here, we explore some of the most widely used technical analysis tools and indicators that help decode market trends and guide trading decisions. Section 10. Fundamental Analysis of Commodity Markets. Fundamental analysis in commodity markets involves examining various economic indicators, supply and demand factors, and other market-influencing elements to gauge a commodity's value. This method is pivotal for traders and investors who aim to make informed decisions based on more than just market sentiment or technical trends. By understanding the broader economic landscape, stakeholders can forecast future price changes more accurately and make tactical buying or selling decisions. Section 11. Sentiment Analysis in Trading. Sentiment analysis in trading is a fascinating approach that blends psychology with quantitative finance to predict market movements. By gauging the market's mood or investors' attitudes towards particular securities or the broader economy, traders can gain insights into potential price movements before they are reflected in the numbers. Section 12. Quantitative Models for Commodity Trading. Quantitative models have revolutionized commodity trading, providing traders with sophisticated tools to predict market movements and make informed decisions. These models use mathematical formulations and statistical methods to examine market patterns and historical data, assisting traders in understanding patterns and potential future outcomes in commodity prices. Section 13. Combining various analysis techniques for optimal strategies. Combining various analysis techniques to craft optimal trading and investment strategies is akin to assembling a multi-dimensional puzzle. Each piece represents a different analytical approach, and together, they provide a clearer picture of the market's potential movements and opportunities. In the complex world of finance, where uncertainty is the only certainty, employing a multifaceted strategy enhances decision-making and mitigates risk.